Imagine it is November 30th, 2001. You are a 42-year-old bank manager living in Buenos Aires, Argentina. Your name is Roberto. You have a 2-bedroom apartment in the Palermo neighborhood. You have worked at the same bank for 14 years. You have approximately 38,000 US dollars saved across 2 accounts, a peso account and a dollar-denominated account that you specifically chose because you were told it was protected. Your daughter is 8 years old. Your wife teaches primary school. You are not rich, but you are not poor. You are exactly what people call the backbone of a country. You are the middle class. Every morning you take the same bus to work. Every Friday evening you stop at the same bakery and buy bread and alfajors. You have a small collection of gold jewelry, 2 rings, a bracelet that belonged to your mother. You feel secure. You have savings. You have a job. You have gold. You go to sleep on the night of November 30th feeling, all things considered, fine. If you have ever wondered why the people who felt the most prepared were often the most devastated when the floor finally gave way, stay with me. What you're about to hear is not a theory, it is a pattern. It has happened before in multiple countries, across multiple centuries, always beginning with ordinary people who believed they had done everything right. And it always ends the same way. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. When Roberto woke up on December 1st, 2001, the Argentine government had frozen every bank account in the country. The policy was called the corralito. Think of that word for a moment. In Spanish, corralito means a small pen, a small enclosure, a cage just big enough for you to stand in but not move. Roberto's $38,000 were now locked inside that cage. He could withdraw a maximum of 250 pesos per week. That was it. Not because his bank was insolvent, not because his money was gone, but because the government had decided overnight that he no longer had free access to what was legally his. Within weeks, Argentina defaulted on its national debt. At the time, $141 billion, the largest sovereign default in history up to that point. By early 2002, the peso was devalued from 1 peso per dollar to eventually more than 3 pesos per dollar. Roberto's dollar accounts were forcibly converted, pesified, they called it, at a rate that wiped out nearly 2/3 of their real value. The gold jewelry he had kept at home, it still existed. It still had physical form. But where was he going to sell it during a civil emergency? To whom? At what price? While there were riots in the streets and 5 different presidents in 2 weeks, this video is about the single most dangerous idea that circulates every time the economic system shows signs of stress. The idea that gold will save you? It will not. History says otherwise, and the historical record is not subtle about this. It is blunt. It is repeated. It is consistent across countries, across eras, across entirely different types of collapse. Today, we are going to look at exactly what happened, why it happened, and what the people who actually came through these events had in common. Because it was not gold. Before we go further, there is something important to understand about why gold fails when it matters most. Gold has a problem that its most devoted believers almost never talk about, and the problem is not about gold itself. The problem is about the gap between what gold is and what a real collapse actually demands from you. Let me explain this with a simple idea. Imagine a fire starts in your house. You have 2 things you could grab as you run out. One is a thick stack of $100 bills. The other is a solid gold bar worth $50,000. Which one saves you that night? Which one pays for the hotel room? Which one buys you food the next morning? Which one lets you make a phone call? This is a simplified version of the exact problem that people facing real collapses encountered. Gold is a store of value. That means it is designed to hold purchasing power over long periods of time, years, decades. But a collapse does not give you years. It gives you days, sometimes hours. And the assets that protect you in the long run are almost never the assets that protect you in the short run. There are 4 distinct ways that gold fails during an actual economic collapse. The first is confiscation. Governments in crisis almost always move to control gold because gold represents the one asset that competes directly with their authority over money. If people can simply opt out of the system using gold, the government loses control of the crisis narrative. So they remove that option. The second failure mode is liquidity. Liquidity means how easily you can convert an asset into something useful. Cash, even bad cash, has high liquidity. You hand it over, and something comes back. Gold has low liquidity in a crisis. You cannot buy bread with a gold coin. You need a buyer, a fair price, and a functioning market. All 3 of those things collapse simultaneously in an actual emergency. The third failure is capital controls. Governments do not only freeze bank accounts, they restrict the movement of all high-value assets. You cannot always walk across a border with gold. You cannot always sell it legally. You cannot always ship it. The fourth failure is perhaps the most quietly devastating. During acute collapse, what people actually need has almost nothing to do with stored monetary value. They need food, medicine, clean water, Fuel, trust, social connections, the ability to call in a favor from a neighbor. None of those things can be purchased with gold when the system that puts a price on gold has temporarily stopped functioning. Gold is not a useless asset over a long time horizon. That is not what this video claims. What this video claims is something the historical record proves repeatedly. In the specific, acute, dangerous window of a real collapse, gold fails ordinary people in ways that are predictable, documented, and still not widely understood. This brings us directly to the first major case study, and this one will shock you, because it did not happen in a struggling, developing economy. It happened in the most powerful country in the world. It happened in the United States of America. And the man who did it was one of the most celebrated leaders in American history. On April 5th, 1933, President Franklin Delano Roosevelt signed Executive Order 6102. The order required every American citizen to surrender all gold coins, all gold bullion, and all gold certificates to the Federal Reserve by May 1st, 1933. Not some gold, all of it. You were allowed to keep a maximum of $100 worth of gold in coin form. You were allowed to keep gold used in dentistry or in industry. That was it. Everything else had to go. The price the government would pay you was $20.67 per troy ounce. You did not get to negotiate. You did not get to say no. The penalty for refusing to comply was a $10,000 fine. Adjust that for inflation, and it equals approximately $167,000 today, or 10 years in federal prison, or both. The United States government collected more than 600 tons of gold from its own citizens in a matter of weeks. And then, within months, the government did something that should permanently reframe how you think about the gold as safety argument. The moment the gold was safely inside government vaults and out of private hands, Roosevelt signed the Gold Reserve Act of January 1934. He revalued gold from $20.67 per ounce to $35 per ounce, almost overnight. That was a 69% increase in the price of gold. The citizens who had been forced to sell at the lower price received nothing. Every single cent of that gain went to the government. Let that sit for a moment. The people who followed the law, who did what they were told, who handed over the one asset they believed was untouchable, they lost 69% of their gold's real value in the transaction, in a single government action. Now understand what this means for the gold will save you argument. Gold is the most politically dangerous asset to own when a government is in genuine crisis, because gold is the one thing that competes directly with the government's currency. And governments in genuine crisis do not tolerate competition. The Swedish government's response became a model that economists still study today. Instead of hiding the problem, Sweden forced its banks to fully disclose their losses. The government then split the bad assets, the toxic commercial real estate loans, into separate entities, sometimes called bad banks, where they could be worked out over time. The government nationalized, meaning took public ownership of two major banks, Nordbanken and Gota Bank. Shareholders were wiped out. Depositors were protected. And over the following years, the Swedish economy was able to rebuild on a foundation of honest numbers rather than pretend ones. Sweden came out of its crisis faster than Japan specifically because it chose transparency over extend and pretend. Now observe what all three of these cases have in common. The Texas savings and loan crisis of the late 1980s, the Japanese commercial real estate collapse that began in 1991, the Swedish banking crisis of 1990 to 1994. Look at them together, side by side. In every single case, the setup was the same. A period of financial deregulation, or easy credit, created a surge of lending into commercial real estate. Values rose far beyond what underlying rents and economic fundamentals could support. Banks competed to lend more, accepting inflated properties as collateral for bigger and bigger loans. The cycle fed itself for years, creating the feeling, the universal, unshakable feeling, that property values could only go up. And in every single case, the trigger that broke the cycle was different. An oil price crash in Texas, a central bank raising interest rates in Japan, currency pressure in Sweden. The trigger was always different, but the result was always the same. A flood of overpriced commercial real estate debt coming due at the same time that values were falling. Banks quietly insolvent, a credit crunch rippling outward into the broader economy. And ordinary people, who had nothing to do with the commercial office tower transactions that caused the problem, paying the price through job losses, frozen credit, and years of stagnant growth. Most people will never know what you now know. Most people will look at a news headline about commercial real estate and scroll past it because it sounds technical and irrelevant to their daily life. If you are still watching this video, you are not most people. You've just seen the same mechanism play out across 3 different countries in 3 different decades, and you now understand why commercial real estate is not a niche financial topic. It is a foundational risk. Hit subscribe, because the next section is the part this channel was made for. The part they leave out of textbooks, the part about who actually gets hurt and who somehow walks away fine. This is where the story becomes personal, because the collapse of commercial real estate markets does not damage everyone equally. History is extremely clear about this. At the top of the list of those who bear the worst consequences are the depositors and customers of small and mid-sized regional banks. When a regional bank goes under because its commercial real estate loan book has collapsed, the people who lose sleep are not wealthy hedge fund managers. They are small business owners who kept their operating cash in that bank. They are retirees who thought their savings account was the safest place in the world. In the savings and loan crisis, the Federal Deposit Insurance Corporation, the FDIC, the government agency that guarantees deposits, was strained to its limits. And that was with losses of $132 billion. Today, regional banks hold over $2.7 trillion in commercial real estate loans. The scale is simply different. The second group that consistently absorbs enormous damage is pension funds. Pension funds, the pots of money that are supposed to pay the retirement benefits of teachers, police officers, firefighters, and government workers, typically allocate a portion of their assets into commercial real estate. It is supposed to be the safe, stable part of the portfolio, the part that does not swing wildly like stocks. But according to data from the Wall Street Journal and CRE Daily, large public pension funds in the United States recorded their first annual real estate loss since the pandemic in the years following the 2022 interest rate rises, with a negative 6% return on real estate holdings for the full year. A negative return on the assets backing the retirements of millions of public sector workers. This is not theoretical future pain. It is already happening. The third group is the cities themselves. This is the mechanism that urban economists call the doom loop, and it is perhaps the most insidious of all. When office buildings empty out, the property tax that those buildings generate disappears. Property taxes are the lifeblood of municipal budgets. They pay for schools, trash collection, police, fire departments, road maintenance. When a downtown loses its office tenants, the city loses its tax base. Facing falling revenues, the city cuts services. Residents and businesses begin to leave because the city has deteriorated. As they leave, the tax base falls further, which triggers more cuts, which drives more departures. The loop feeds itself downward. This is not a hypothetical scenario. Detroit experienced it to its extreme end over decades. San Francisco has seen significant elements of it post-pandemic, with major corporate tenants vacating downtown offices, city tax revenues under pressure, and visible urban deterioration driving further departures. And researchers studying the dynamic now find it playing out to varying degrees in Seattle, Portland, Chicago, and other major American cities. Meanwhile, at the other end of the table, some participants consistently come out of these events without serious damage. History shows that those who walked away from commercial real estate crises without catastrophic losses shared a few clear characteristics. The question is not whether this pattern will repeat. History has already answered that. The question is whether you will see it before it sees you. If this channel helps you think differently about the world around you, subscribing costs nothing, and it might change how you see the next headline about an office tower going into default, or a regional bank reporting surprise losses on its real estate loan book. Because those are not isolated events. They are the early symptoms of a mechanism you now understand. The historical record shows that those who came through commercial real estate crises largely shared three characteristics. The first is that they were not concentrated. They had not put a disproportionate share of their wealth, their savings, or their institutional portfolios into commercial real estate when valuations were at their peak. In every single historical case we have examined, the people who suffered most were the ones who were the most concentrated, the most heavily committed to a single asset class at a moment when that asset class was priced for perfection and supported by nothing but continued debt expansion. The second characteristic is that the survivors were sensitive to the direction of credit, not just the level of interest rates, but the availability of credit, meaning how easy or difficult it was to get a loan. In each of these crises, the commercial real estate boom was a credit story. It began with easy credit, and it ended when credit became tight. Those who recognized that the loosening of lending standards in the years of the boom was itself a warning sign, not a green light, were the ones who stepped back. In Japan, those who moved significant assets out of leveraged property positions in 1989 and 1990 as the Bank of Japan began tightening preserved their wealth. In Texas, those who recognized that savings and loan institutions were competing to offer reckless loans against overvalued commercial properties had time to act before the collapse. The third characteristic is that survivors held assets that could be liquidated, turned into cash, quickly. Commercial real estate cannot. When the market turns, there are no buyers. A stock can be sold in seconds. An office building in a falling market can take years to sell, and only at a devastating discount. Those who survived these crises, historically, had portions of their wealth in assets that gave them flexibility, cash, short-term government bonds, things that did not lock them into a burning building. It is important to say clearly what this video is not doing. It is not telling you what to buy, what to sell, or what financial decisions to make. Every individual situation is different. There are no universal prescriptions in economic history. History is a pattern recognition tool, not a crystal ball. What it can do is show you the shape of the risk clearly enough that you can ask better questions of yourself, of your bank, of your financial advisor. This brings us back to where we began, to Tokyo in January 1991, to Kenji Takahashi, who had built everything on the assumption that property values could only go one direction. Over the following decade, he lost 2 of his 3 buildings to foreclosure. His bank, which had reassured him for years that everything was fine, was eventually absorbed by a larger institution in the late 1990s as part of the Japanese government's desperate effort to consolidate a banking sector that had been quietly rotting for a decade. Kenji spent his 50s not on expansion, but on survival. He was not careless or stupid. He was a competent man operating in a system that had systematically removed the visible warning signs, that had extended and pretended until the pretending was no longer physically possible. That is what makes commercial real estate crises so uniquely dangerous. They do not announce themselves. They build slowly, invisibly, behind accounting rules that allow banks to carry bad loans as if they were healthy. They build behind a wall of loan extensions that delay the moment of reckoning. They build in the gap between what a building is recorded as being worth and what anyone would actually pay for it today. And then one day, not because of a surprise, but because the delays finally run out, the floor gives way. Right now, in 2025 and beyond, the United States faces a maturity wall of commercial real estate debt, unlike anything since the savings and loan crisis. Office vacancy rates have hit record highs. Urban property values have fallen 50% from their peak, according to PwC data. The office delinquency rate on commercial mortgage-backed securities, meaning securitized commercial property loans, the kind packaged and sold to investors, hit 12.34% in January 2026. Surpassing the worst single month of the 2008 financial crisis. And the bulk of the refinancing pressure has not yet fully arrived. The debt wall grows taller through 2026 and 2027. None of this means a predetermined outcome. History shows that the severity of these crises is shaped enormously by how policymakers respond. Sweden came through far faster than Japan, precisely because it chose speed and honesty over delay and denial. The United States navigated the 2008 financial crisis better than expected, in part because of aggressive and early policy intervention. The shape of what happens next is not written, but the conditions that historically precede commercial real estate crises, overvaluation, excessive bank concentration, rising rates, and a trigger that forces recognition of losses, are all present in this moment. History does not repeat. But, as the saying goes, it rhymes. And right now, the rhyme is very close. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision based on anything you hear in this video. This video is not for everyone. Most people will hear the phrase commercial real estate and assume it has nothing to do with them. But if one person in your life needs to understand why the regional bank they trust, or the pension fund backing their retirement, or the city they live in, is vulnerable to a mechanism that has already played out in Tokyo, in Dallas, and in Stockholm, send it to them. Not because it will change the world, because it might change how they see it. Subscribe for more, and I will see you in the next one.